Are we live?
We're live.
Sounds good. Back on the weekly rebalance.
Absolutely.
Um, it's interesting. Every week, it's you continue hitting higher and higher prices. We continue hitting higher and higher highs in all the indices, which I guess is that's what happens if you look at a chart, right? Everything goes up and to the right if you zoom out far enough, right? I think I don't know, as I was thinking this week, the it's so easy to I mean it's so easy to forget that you're not just chasing the total return. You're also a risk manager. And some of that, I'm not saying that that means take a bunch of chips off the table and sit in cash, right? That's a huge mistake. That could be just as big a mistake, right? But I think it is easy to forget that we're also risk managers in these times as well, especially in these times of lots of new highs being, made consistently over and over again.
Yeah, absolutely. I think that discussion is becoming more and more relevant as well, just with the S&P 500 becoming increasingly concentrated as well. There's no arguing that the returns have been excellent for the S&P 500, and they'll probably continue to be, at least pretty good. The question becomes, in addition to just allocating for potential growth, if that's really just the only focus, but the question really becomes, can you handle the risk of being so concentrated in the top 7 positions, with the Magnificent Seven, or, even the top 10 positions? Just with how concentrated that index is, it's just not a great fit for a lot of people. And keeping in mind that risk is something that needs to be managed as well as the expected return, definitely something important to keep an eye on.
Yeah, exactly. Let's see if we can look up. I'll share my screen here. I'm just kind of curious where we're at now on the S&P. What are the top holdings now? How much do they make up?
Yeah, it fluctuates
Yeah.
a little bit, but I know it's a lot.
Yeah. Let's just use SPY. Look at the top holdings. Let's see. Nvidia is the top holding now, 7.85%. Wow. Very, very concentrated. Let's see if I can take. I almost want to export this to Excel.
Yeah, absolutely. And I think that's just one of the interesting things to talk about with the S&P 500. Again, it's performed very well for someone who's willing to accept the risk that comes along with the S&P 500. For a younger investor that has a long time horizon, doesn't necessarily, they're not going to need the money in a short amount of time over the next couple of years, that sort of thing. So they don't have to worry about pulling out the money during a drawdown that's pretty steep. You know, um, there's definitely an argument to be made there to just going ahead and buy the index. That being said, from just a risk management point of view, it's kind of interesting to also take a look at not even changing the underlying companies within the S&P 500, looking elsewhere, but even just going to something like an equal weighted index can make a lot of sense in some cases from a risk management perspective. Um,
Yeah.
you kind of take out that momentum piece that you get with the market cap weighted um, index, the way that the S&P 500 is. But it's like yeah, it can be helpful.
Yeah, I know, I completely agree. Yeah, it's I feel like sometimes it can be a tough conversation to have with people because I don't know, they feel like you're trying to talk, if you talk risk management, you're trying to talk them out of, investing in these top companies, which isn't true. Like that's not true. But like you said, Nick, making sure that everybody knows that, like, if you just buy the S&P 500, that you know, seven companies here make up 30, almost 33% of the index. I just was doing the math on the other side of what you were talking there. And I mean, 33% is seven companies. So like you said, there are times to, it's good to remember that and remember what you're doing. If if you were to see the individual stocks themselves in here, you would see that, and it would be evident just how much concentration you have in these companies. But does not very evident if you don't have individual stocks. Um, and it's easy to forget those risk controls that you were talking about.
Yeah, I mean, absolutely. And I mean, again, not to be down on the S&P 500, because it can be a great solution for people, assuming they're fully understanding of the risks that they're taking, and it just suits their current client profile, that sort of thing, their current needs. But there's
Yeah,
definitely some implicit risks that you take in there, and with it being the S&P 500, it's not exactly 500 names, but it's right around there. I don't know the exact number, but you anticipate more diversification than you probably end up getting,
right,
just from someone coming in and buying the ETF just based off of guidance they've seen on the internet or any piece like that. And it can be a great decision. It's just as an asset manager, keeping an eye on the risk that your client is taking, along with the returns, keeping in mind that both of those things are two things that need to be balanced to match the investor's profile. um, it's
right,
just something important to review.
right. Yeah, exactly. Well, and you can see that on days like today where the market's down overall 38 basis points losses today. Um, driven by the weights and the top names, the infotech, communication services. If those names have an off day, you could have lots of the sectors, lots of the names within the S&P 500 do very well or have a positive day, and you could be down. It brings that age-old question, why the S&P 500 is, you know, did this today, but my portfolio did this. And if they're allocated, they forget that they don't own just the S&P 500. They own international stocks and small cap stocks and all kinds of different allocations. But you're right. Like, I'm not trying to be too down on the S&P 500 at all. The S&P 500, deservedly so, has gotten a lot of love recently because their earnings growth has been great. You know, um, it's interesting. You look at small caps, smaller caps, and S&P as like the top of the market cap. And I was just looking the other day at this. Let's see. Um, just looking at their valuations, like this is the S&P 500's PE ratio today versus its 10-year average. It's at a 28 times. Um, and the 10-year average is 22.1. And then if you look at a 2-year average, it's 25 versus 28 is the current at the price to earnings multiple. So we're extended on our valuations there, but kind of deservedly so. Like, you've gotten phenomenal earnings growth in a lot of the S&P 500. The small cap companies are almost the opposite. If you look at the S&P 600, which is a good proxy for small cap, they're like fairly valued. I would probably look at price to sales for small caps, but although S&P 600, you could use the price to earnings because it's filtering out a lot of the companies with no earnings or negative earnings. But I mean, much more fairly valued, regardless of whether you look at a comparison versus what it's been the last 2 years or the last 10 years, but much more fairly valued there. It's like the different, they have very different, kind of different drivers right now, but are kind of supported in different ways. The S&P is supported, the S&P 500 is supported by phenomenal earnings growth, and they have this extended valuations. The small cap stocks, they have not had nearly as good earnings growth, but they're supported by this just general cheapness. So just depends, well, which, depends how you look at it. I think generally speaking, US stocks have general support at the moment. There's not some catalyst that's pushing them down in a severe way, but you know, like we mentioned at the beginning of this, still when you get extended valuations, it's increasingly extended valuations, long, drawn out bull markets. The longer the bull market draws out, the more important it is to remember we want to stay diversified. We want to continue rebalancing. That's how you um, continue to maintain high levels of total return, but also be a risk manager at the same time.
Yeah, I mean, absolutely. I think there's along those lines, a couple things to note, just specifically on this screen here that you pulled in from Bloomberg. That band column there tracking, a steep standard deviation above and below that average, and then the column to the right of that being one standard deviation up, and then the column to the right of that being one standard deviation down. Just being within that range. Compared to the S&P 500, which I'm pretty sure when we look at a 10-year and a 2-year, beyond that standard deviation range of what we would typically expect. So just interesting piece there. And let's see here. Yeah,
Yeah, no,
28
you're right.
times, and beyond one standard deviation of the 10-year average. So just seeing that get further and further extended. And again, the earnings growth within these companies here, it's been very impressive. So the growth rate on these companies is very good. That being said, even despite that really rapid growth in earnings, the prices outpaced that by a pretty considerable margin, and to the point where we're beyond one standard deviation above the historical average of the PE ratio for the S&P 500.
Yeah,
So again, I don't think anyone's going to say that these U.S. companies, these large U.S. companies are bad companies by any means. It's just, is the valuation where it currently stands, is it in touch with where things actually are? Um,
right.
just because the earnings growth has been very considerable, and despite that, the prices outpaced it by a good amount. So again, going back to that piece of being a risk manager, taking a look at that number and making sure that that's in line with what the client's willing to bear, that sort of thing. In the
Yeah.
event that we do have some sort of a correction um, at any point in time.
Yeah, yeah, exactly. It's a good reminder of why we rebalance. And rebalancing, for example, or is really, rebalancing. I think people falsely think of rebalancing as a total return enhancer, which is, in my opinion, incorrect. I mean, if you think at its simplest form, if you have a 60/40 or 70/30 portfolio, and you have risky high growth stocks, and you have more conservative low growth fixed income, and let's just use 60/40 as the example. If you go from 60/40, and as your equities generally perform better, you drift to 65/35, 68/32, 70/30, etc. If you were to never rebalance ever, you would consistently have a higher and higher makeup of equities. And the that would over time mean that you have a higher and higher expected rate of return. As you own more and more percentage of equities, you would expect to have a higher rate of return going forward if you never rebalanced. And you rebalance, and there is this element, I think sometimes, again, not that it's not totally, not that it's true in all cases, but sometimes there's this element where people will think, well, we're buying low and selling high. And that is true to some degree, right? Um, for example, in the case where you were 60-40 and equity sell off and you're now 55-45 and you sell fixed income and you buy equities, that's great, right? And there is an element of providing some extra total return there. But generally speaking, because in most cases you're talking about equity markets moving up and to the right, more conservative assets moving, more horizontally across the page instead of up and to the right. And yeah, the rebalancing is a risk control more than it is a total return enhancer. But it's why we rebalance is we're trying to rebalance and keep risk control, when we assign a client to 60-40 or 70-30, making sure that is continuously managed and not, all of a sudden you wake up 10 years down the road and you're 80-20 and you really are supposed to be, that's way more risk than you're expecting to take.
Absolutely. And I think on top of that, even just within equities, if we're talking about 100% equity sleeve, just looking over the past 10 years with growth and, market cap weighted indices performing so well, I mean, just taking a look at the underlying factors that have performed well, momentum has been one of the big drivers of return over the past 10 years. And when you rebalance, you're inherently kind of taking away from that momentum allocation because you're selling off some winners and you're buying some losers. So when you rebalance, you're kind of taking some of that momentum factor out of your portfolio, um, which again is a great risk management tool, but potentially takes some return off the table in the event that momentum continues to do well.
Right.
But that being said, it's kind of irrelevant if the client can't handle the risk.
Right. Yeah, exactly. I think that is an easy thing to forget until you see, you see the value in that in the times of stress, staying diversified, rebalancing, and during times of stress, rebalancing during times of stress gives you that opportunity to take advantage of some lower priced assets. If you stayed diversified and able to hold up your portfolio value over time instead of getting too concentrated, then you get that opportunity. But like we've said here, and I don't want to beat this too much to death, but it's really is a risk management tool as much as, if not more than anything else. So a good reminder of why we go through these things. I feel like it's not the exciting thing to do, right? It's boring to talk about, hey, we're going to continuously rebalance. It's more exciting to say, let's pile into Nvidia or Tesla or whatever, the Apple or whatever the name is, right? That's doing great at the moment. But that is, you know, not necessarily the best thing for anybody long term.
Yeah, yeah, absolutely. Especially if you're potentially drawing down a portfolio.
Yeah, exactly. Right. Like you, good point. Especially, I mean, this is probably true. This is not true of every client, obviously, but a lot of the clients that we're working with, they are, if they're not living on the portfolio at this point in time, they're, at some point going to retire and live on this portfolio, and they'll be very glad when you are putting in place the proper risk controls that help them, be able to withdraw from the portfolio during times of stress and really be able to be okay and diversified in any different types of potential, market storms out there.
Yeah, no, absolutely. Absolutely. Um, and I guess, yeah, that kind of hits on, I guess, some of the different goals of a rebalance versus a reconstitution, especially in something like a tactical portfolio where that reconstitution is really targeting some additional return that's expected in some area, whereas a rebalance, we're just kind of getting back in line with our current target, that sort of thing.
Right.
So not to say that, all of the rebalancing, reconstituting activity that we do when you get emails from us, that sort of thing, is not with returns in mind, because there's certainly some where, we're targeting something that we think is going to perform very well in the near future. But just a standard rebalance, like you said, keeping an eye on risk, definitely an important tool in that realm.
Yeah. Yeah, agreed. So with that being said, Nick, outside of the publicly traded securities, liquid securities, there's um you were mentioning some changes recently that are occurring in the private equity space. We talked a little bit earlier today as well about some other opportunities to diversify outside of your public equities. Well, fill me in a little bit more on the some of the changes in the private space that are coming down the pipeline.
Yeah, I mean, it's just coming down the pipeline. We're likely we're going to end up in a world where people can access private equity and similar assets in their 401ks. Um, so that's coming down the line. The administration has been pretty um, pro getting those things regulated to the point, or deregulated, I guess, to the point where they can be accessed by investors in their 401k. Um, so just opening up access to that market that's been historically pretty illiquid, and still going to be an illiquid asset, just being private in nature, but also just being a little bit more exclusive and a little bit more difficult to access, especially if you're not, an extremely wealthy individual with lots of money to lock up for an extended period of time. So, um, just I guess we're seeing a little bit more access to private markets. More clients are probably going to have that in their portfolio day to day, especially if you contribute to a 401k. So just we're seeing more access to the space. More investors are going to get an idea of what that's like to actually own assets like that in their own portfolios.
Yeah. What do you think of that? Do you think that's good, bad, indifferent?
Yeah, I don't know. It's kind of tough to say at this point. If I'm a private equity manager, I'm jumping up and down in excitement. I don't know, as an investor. I don't know. It's kind of one of those things that'll be interesting to watch play out, just because the private equity space with its illiquidity, that much capital flowing into a system like private equity, it's going to create a lot of demand for deals in a space that's becoming more and more crowded, and it's becoming more and more difficult to get those crazy returns that we saw at the beginning of private equity markets being launched, particularly like, when David Swenson was working with the Yale Endowment and they were getting these crazy monster returns from these alternative assets with the liquidity premium. There weren't as many players in the space. And so anyways, it seems like the return's been coming down a little bit, and potentially, the correlation creeping up, or maybe we're just coming to realize that the true correlation number, I guess that kind of depends on your viewpoint on that. But I don't know. It'll be interesting if it retains its kind of signature private equity qualities, which is, extremely high returns and low correlation. Again,
Yeah.
that low correlation could be debated, but
Yeah, that's always the question is how is the low correlation just coming from the lack of frequency of reporting data? You're getting equity valuations priced by the second, and you're getting private equity or a private venture priced by the quarter, which is, I mean, it's almost not even comparable to do a calculation of correlation. Um,
yeah.
so yeah, it's hard to say. I share your sentiment there with some unknowns about how that reflect and whether it's a good or a bad thing for markets. I mean, generally speaking, I'm a fan of access for more individuals to any type of investment, right? Um,
Yeah.
However, it's interesting, like you said, you cited Swenson. There was a recently there was an article written by the blanking on his name now, the guy that worked with Swenson for like 35 years he's retired now.
Yeah, I know which article you're talking about, though.
Basically, yeah, he was like the top guy, along with Swenson at the Yale Endowment. And he was basically a big proponent against easy access to private markets. And his thesis was part of his thesis was basically that the difficulty of access is that's how you that's part of the premium. You're receiving the premium because you're having to work a little extra hard. That's
Yeah.
oversimplifying it, but there's some value to that. And it makes me, one of the things I think that's, interesting is, some of the what some of the smaller funds, smaller investment vehicles, smaller investment opportunities that do have that have that truly they're not commoditized yet are some of the most attractive deals that I have come across over the past number of years. The ones that are commoditized are a little less, I don't know, a little less intriguing to me, but maybe that's just some personal bias.
Yeah, I mean, deal sourcing does become an issue at some point. If you've got so many dollars to allocate, um, it can eventually become an issue. And then on top of that, some of those funds typically rely on leverage to increase their return. So, like, if you've already got a ton of capital to deal with, and then on top of that, you want to lever up to increase your returns to get some of those signature private equity returns, that sort of thing. It can just get a little bit difficult.
Yeah.
Um, Especially, like I think private credit too is an interesting space as well. Another great asset class that we've liked for a while. With more dollars flowing into the system, these private credit, typically you're getting compensated for additional credit risk in some cases, and additionally just like unique circumstances around the loan, depending on what type of private credit you're doing. But some of these people that are looking to borrow money in this way, they've tried to borrow it through the conventional terms, or it's just not open to them. So as more money flows into private credit, there's more and more people willing to, offer that kind of debt to people looking to take it on.
Yeah.
That yield potentially comes down. So I don't know. It's interesting. Like you said, I think getting people access to any type of investment is, in general, a good thing. Um, but maybe it takes away some of those characteristics that we've known private equity, private credit to have, just as it becomes more and more mainstream.
Yeah.
Um, and I think, too, just with the current behavior that we know, like a 401k, especially for a younger person, is a great place for these kind of assets.
Right.
Um, potentially not touching them for 30 years. So
Yeah.
potentially can take
Agreed.
on a good amount of risk. The lockup period, really, if you're under 59 and a half and you've got a little while to that point, it's almost a non-issue.
Yeah. Yeah, exactly. Well, I think we're going to have some interesting discussions about this in the future. We, you know, not to talk about today, but behind the scenes, we've been having some discussions about how to offer these types of investments at a more competitive, in the most competitive way to investors, and that some more stuff coming on that pretty soon. So I don't know. It'll be an exciting space to follow the coming, not just the next coming couple of months, but really coming couple of years, because I think a lot is changing there.
It is an exciting space, and yeah, those
Yeah.
opportunities that are coming, I'm pretty excited to offer those as well. Think
Yeah.
that they're a good offering in the space, so really excited about those. But just as a whole, yeah, it's going to be really interesting to watch that asset class and the actual behavior.
Yeah. Yeah, exactly. Um, changing uh changing topics here real quick. I saw this stat this week. I didn't verify it, so I'm putting that disclaimer out there first, but I trust where I got this information from. But so far this year, um the ETF fund flows to gold, 4 times the flows into gold than that of Bitcoin this this year. And it was one, we talked a little bit about gold this year and how it's actually outperformed the S&P, or performed very actually. I think our study suggested that it actually outperformed the S&P over the last 25 years. It's interesting connecting that to the Fed is likely to cut rates again in October and probably another time before the end of the year. Looks like sometime next year we're going to get to 3%. So we're cutting again. We continue to run a deficit. Um, those assets that are hedges against that risk there, like gold, Bitcoin too, potentially. Um, but gold is the traditional one, right?
Yeah.
They've been supported heavily. So that was a surprising stat to me, but it is, and I think that would surprise a lot of people. Two things about gold. One is it's outperformed the S&P over the last 25 years, and or even I think it would surprise people that it's even performed close to the S&P over the last 25 years. And
I mean,
then that it's out there've been more flows into gold this year than even Bitcoin, even when Bitcoin is surging at near all-time highs or at all-time highs, and it's gaining more and more traction. It's only 1/4 of the flows that gold is getting this year.
yeah, it's definitely an interesting thing to talk about. I mean, just real assets do relatively seem attractive right now. Given inflation pressure to the upside and continued expectation of Fed cuts. Um, in terms of those flows into Bitcoin versus gold, how much of that do you think is influenced by um, the demographic that holds, the majority of assets right now? So I know, typically people who are in their retirement right now, they're typically a little bit more hesitant to go out and buy Bitcoin. Not to say that everyone is. There's
Yeah.
definitely people that are super excited about it. But for the most part, I think people in that group that definitely have more assets to invest, they're probably a lot more comfortable with gold than they are with Bitcoin. Um, so
Yeah.
I don't know. How much do you think that weighs into the flows there?
I think that's definitely part of it. Um, but I think you definitely that's definitely true. But I don't know. Still surprised, still a little. Some of our Bitcoin bros would not would not believe that, right? But
Yeah. No, it's definitely interesting. Especially with just all the excitement around Bitcoin, crypto markets as a whole. I think you see a decent amount on financial news about gold right now, but definitely not nearly as much as you see on crypto, largely coming from um, the further integration of it into our financial system. So, yeah, that is interesting. I would never have guessed 4 times the amount into gold as Bitcoin.
yeah, exactly. And I was just looking up the returns on gold. I just used the gold ETF GLD versus the S&P 500. Looking at the last 20 years, it's just confirming what we talked about. But they've almost performed identically. Um,
Yeah.
if you include the reinvestment of dividends.
Yeah.
But yeah, I mean it's interesting. Just definitely getting a lot of traction. I think there's some validity to why. I mean, you continue to run, the government brings in 5 trillion a year in revenue, tax revenue, and spends 7 trillion a year. So we add 2 trillion a year to our deficit. That definitely devalues the currency,
We,
devalues the um, it adds risk every day that we continue to run a deficit, every year that we continue to run a deficit, it runs the risk that um, your assets. Well, I mean, you know what it does is it continues to widen the wealth gap. So you own assets, real assets particularly get a tend to have a boom during periods where where interest rates come down, where money gets cheap, where spending is high, that kind of stuff. But anybody that owns assets, whether it be stocks, real estate, gold, uh, could be Bitcoin or Ethereum, any of those type of anything that is an asset and not a liability to yourself is exceedingly or just more and more valuable throughout time. Um, I do hope that switches and we can actually run a balanced budget here in the US, but I don't know when that's going to happen, but you see what happens if you read like Dalio's books and you do a deep dive or a study on what happens as the countries rise and fall, how they treat their currency and how they pay their debts. If they continue to just print money when they need to pay their debts, the value of that currency continues to deteriorate over time. It diminishes their power to trade globally with other countries across the world. You know, um, it's a risk, and that's why you see things like gold get a get an increase in price during periods of time where spending is high, money is cheap, and the currency is at risk.
Yeah, no, I mean, absolutely. And then I think the other interesting thing too, and we've kind of talked on this as well, but speaking about the debt, just taking a look at the yield curve, we're expecting yields to not come down nearly as much on the far end of the curve as we are on the short end. Just, the Fed controls the very short end of the curve, and then beyond that, it's largely inflation expectations, GDP growth, and then also, credit risk of the underlying um, country, the issuing currency, and the entity that's issuing the debt. But you know, we've been in a period where even on the long end of the curve, money has been extremely cheap for the past 10 years.
Yeah,
Um, and we're not in that environment anymore. Probably not going to go back to the historically cheap rates that we saw
right.
um, throughout that period. So the interest on that debt is even higher than it was at some point. So it will continue to climb just as it gets refinanced. And so yeah, it's definitely an interesting time, but has made gold look more and more attractive.
Yeah, yeah, and
Another
then
thing that's
in
notching all-time highs alongside the S&P 500, which is really interesting. Really
yeah,
interesting.
exactly. Yeah, notching more and more all-time highs. Yeah, we'll see how that all that interacts because it's a little more nuanced and complicated than we said there. I mean, the other interacting factors here is other countries are doing this as well. So how on a relative basis do we you know do we do we experience this? But um, anyways, certainly a risk out there.
Yeah, I mean,
So
absolutely.
yeah, when we'll see what the Fed does. It's interesting as they compete or they watch these competing factors with inflation. I don't necessarily think that it's not to the Fed's stated target even yet. So we're not there yet. We're not down to the stated 2% target yet. We're still above that. So you have to continue to say inflation's running hot. Now we're cutting rates. Um, so you got that issue, but you've also got the jobs market struggling. Uh, I think it was ADP came out with their numbers recently and more job losses and struggles in that market as well. So you gotta, I don't know. I don't think I'd ever want to be chairman of the Fed or a Fed governor, even if it was offered to me. That's one of the, sounds like a terrible job, but they are struggling. It's a struggle. You can see their struggle trying to balance the need to keep inflation in check, to keep employment in check, and you know, obviously at the moment it seems like keeping the jobs market trying to keep employment at full employment or as close to that as possible is winning out over inflation, but we'll see. That's going to be probably some of the most interesting things to watch this week, or just what are there's not a lot of macro data coming out this week, but the Fed commentary. There's a lot of Fed commentary coming out or expected to come out this week as well, which will be very interesting to follow and hear their context as it relates to those two elements.
Yeah, I mean, on top of that, we've got the government shutdown, which has been delaying the release of certain data points, specifically related to employment.
Right.
So, uh, yeah, I mean, like you said, we've got ADP data and a few other, third-party data providers, but
Yeah.
government data providers have been delayed in releasing their data because of the shutdown. So just
Yeah.
presents another little element of uncertainty.
Yeah. And speaking on the shutdown really quick, I mean, markets have kind of looked past it, I would say, even though it's still going on. And at the end of the day, it's probably one of those things that is, I mean, most likely not a major impact or a watershed moment in, the turn of the markets here. However, there can be some lasting effects. It can, a couple things that that can come from it is, one is you could see spikes in things like unemployment, for example, temporarily, that then get, reversed later on in a report. But so and most of that loss in the economy is then made up later by uh, catch up pay and et cetera. But some things are lost, like when the government isn't operating. I mean, think about it, all these I mean, just a silly example, a bunch of government workers coming in to not coming into work anymore, not going and buying gas, not going and spending money on whatever that they would use to. There's just less activity, maybe less likely to spend money while their while their paycheck is in flux. So there are definitely some lasting effects there. Again, I don't expect it to be this watershed moment at all. I think we've seen government shutdowns before, and you can see the market is looking right past it. Equity markets looking right past it, almost pretending like it doesn't exist. But we'll, could see some interesting flux, some data points in flux that wouldn't normally be in flux, and could create a little bit of nuance there. But again, likely not to create a massive turn of events here. But certainly having
Yeah.
some data points were delayed as well, though.
Oh yeah, I mean absolutely. And then on top of that, from the employment perspective, yeah, we will see a temporary spike probably in unemployment, like you mentioned. But on top of that, there's discussion of using this to further fire, essentially permanently let go some government employees with this particular shutdown, which again adds pressure to unemployment and the jobs market as a whole.
Right.
So just another interesting little piece going on here.
Yeah, for sure. Sounds good. Well, you got any final thoughts, Nick? That's kind of all I had on my mind for today.
No, nothing else. I think we got through a good amount of data.
Sounds good. Yeah, this was our longest podcast yet. The best one we've ever done.
Yeah, there you go.
All
There you go.
right. I guess we'll see everybody next week.
All right, sounds good. Bye,
Thanks,
everyone.
Nick. Bye.